you know, stocks, U.S. stocks may not be a great buy, but people have to put their money somewhere, and they simply don't know where else to put it. And they figure this is like it's the least bad alternative. I think that what some of you are saying is actually there are much better alternatives, but people are not thinking broadly enough. Is that fair?
Yeah. You bet.
Barbara, if you look at the whole world, what's your top recommendation as far as a place to put some money now?
Well, we think that equities broadly still are probably the best asset class, and we do broad asset allocation across many asset classes.
Equities globally?
Equities globally, but specifically in Europe. When you think about the risk premium that's awarded to investors to own equities versus, say, something like the risk-free rate or treasuries, it is still abnormally high for where we are in this point of the economic cycle. So we think investors are going to be rewarded for that. But when we take a look for where the fundamental change at the margin is probably the greatest, we see it is indeed Europe coming out of recession. Think about this. The peripheral countries in Europe, in Spain, in Ireland, and Portugal, exports are back at their pre-crisis highs. So there's been a real change that we're seeing in Europe.
Tom, I was talking the other day with a former CEO, a quite well-known former CEO, and to my amazement, he was saying that he just wasn't comfortable investing outside the United States. This is a guy who had done business globally. For whatever reason, he just wasn't comfortable investing outside the United States. He wanted to stay in the U.S. If he were calling you on the phone and saying, look, I want to put it someplace in the United States, what would you say to him?
Well, I'm going to assume he's looking at finding an asset or an idea that's going to outperform for more than just a quarter or two. So something 2 to 3 years. I think one of the best opportunities in the stock market today is large cap technology, because what you're getting there is you're getting a group that's essentially been orphaned. The group has never been cheaper. I think it's on a relative PE the cheapest in more than 35 years. It's the most non-consensus group. So if you look at first call mean rating, or what Wall Street has buys on, it's the least liked sector today. But what you're picking up is top line growth that's double US GDP, free cash yield of over 10%, and you've got a free call option if in fact technology spending is bottoming. And for many readers here, technology spending's been terrible for 7 years. And we think we're at the end of that cycle. And if it's true, we're going to get double-digit growth in large cap tech, and this is a group that's going to re-rate from 11 to 12 times towards 15, which is a huge move.
So we're looking at Microsoft, Intel, Cisco, HP,
yes,
IBM.
all of the above.